Hello everyone and welcome to This Week in the Markets. So there were quite a few interesting data from US and China last week, and so we'll spend some time in this video discussing the implications. And also a number of companies reported their third quarter earnings last week, and so we'll go through a brief summary of the current performance and also what we see in the numbers. But firstly, we'll go to our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So inflation data was out in US last week, and we are of course watching this closely as our underlying belief is that the mass monetary expansion by the Fed will eventually put upward pressure on inflation. So we're interested to see when it would actually show up on actual data. Both the producer price and consumer price index are increasing at an annual rate of 2.1% and 2.0% respectively. This is not alarming yet, but it is interesting that both indices have exceeded analysts' expectations. Some other data were also released last week that suggests that inflation could become a problem for US in the near future. Now, one of the reasons why the effect of the Fed's quantitative easing program have not been translated directly into high inflation yet is because of lack of consumer confidence and spending in US. So the money has not been circulating around the economy as quickly, or in other words, the money velocity had been quite low. Nonetheless, the latest consumer confidence survey, as measured by the Reuters and University of Michigan, points to the highest confidence level in 5 years. If this is true, we should see a pickup in consumer spending over the next few months. Furthermore, the retail sales figures were also quite positive, as sales exceeded analysts' forecasts to grow at one of the fastest pace in the past couple of years. Not only is this good for the US economy, but if the trend continues, it would also be positive for assets that perform well during high inflation, such as equities and precious metals. And we will also become more bearish on assets such as long-dated US Treasuries that underperforms in an inflationary environment. China reported quite some positive data last week as well. Firstly, over the weekend, it reported its exports growth for September, which came in at 9.9%. This is almost double the consensus of 5%. Then early today, it reported its third quarter GDP figures, which grew at 2.2%. Its industrial production grew at 9.2% in September. Retail sales grew at 14.2%, and urban investment increased by 20.5%. All these data were quite a bit better than expected and suggest that perhaps all the concerns over China may have been all priced in now, and the markets may have even gone a bit too far. The Shanghai Composite had been falling for several months now. The rate of decline seems to have slowed down in the past month though, and some buying interest seems to be coming back into the Chinese equity markets. It may be a bit too early to say that the index has found a bottom, but it seems to be moving in that direction at least. So far, there have been about 78 companies reporting earnings in the S&P 500 since the earnings seasons began last week. And it is proving that the market's pessimism is unfounded, with the majority of companies exceeding analyst earnings expectation, and there's an average surprise factor of 6.44%. Revenues continue to be mediocre like other earnings seasons, with just around 0.52% above expectation. And interestingly, currently leading the pack is the financial sector, with especially strong performance from banks. On average, company within these sectors has beaten earnings expectations by 12.15% and beaten revenue expectations by 2.65%. We think that a strong performance in the banking sector could be a sign of recovery in the housing market in US, and also probably also affected because of the Fed's easy monetary policy. With the Fed's QE3 program coming into actions, we would expect the purchases of mortgage-backed securities to continue boosting the housing market as well. And in fact, if we think that the home builders have any clue about their business at all, then we would also find the housing start numbers and the building permit numbers yesterday to be a reaffirming signal for the housing market in US. According to this data, there are 13% more houses going into construction than estimated, and 60% more than the level at the beginning of last year, so there's quite some progress we've made there. And because of that, we're quite bullish on the housing sector in US and also the banking sector. One way that we can gain exposure to the housing market is through the real estate ETF, IYR, which has recently pulled back and is now consolidating at the $64 level. This is one area that we think has strong potential and also helps to distance ourselves away from the uncertainties in Europe. Another ETF that we like is the Regional Banks ETF, KRE. Regional banks tend to benefit more from a housing recovery and also have less exposure to international markets, and therefore we again be less exposed to the Europe sector, which is one area we try to avoid, and we rather focus our exposures on the US economy, which seems to be recovering slowly but surely at least. And that's all for the updates that we have for you today. We'll have another update next week. Until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.